Hello and welcome back to the Note. Still in Panama today. I'm now at the airport, and while I've been at this conference I've missed an awful lot of fun and games in the capital markets back in New York. We've heard from the Federal Reserve today. As predicted, Janet Yellen has decided that she is no longer patient about when they will start to raise rates again. That was widely predicted. As also predicted, she has, however, given herself a lot of wiggle room over whether she's really going to start raising rates in June. In fact, she's given so much wiggle room that the response has been a very dramatic one in markets. People now think that it's unlikely that we'll see rates go up until October. To be precise, she made clear that while she was no longer patient, she wasn't impatient either, and there was a very important reference in the communique to the fact that growth has been moderating and that there are some complaints over exports. That is a veiled comment about the strength of the dollar. As a result of this, you saw a remarkable move back in currencies. The euro gained more than 2% against the dollar. That doesn't happen very often. You saw stocks rally significantly in the US, more than 1% on the main indices. Obviously, lower interest rates for longer is good for stocks. Meanwhile, yields on bonds came down very sharply. The 10-year yield is now close to 1.9% again. What are we to make of all this? Well, the extent of the bet, the degree to which people had committed themselves to the notion that there was a divergence between monetary policy in the US and the rest of the world had plainly been overdone. There was always going to be a risk that something like this could happen given how exposed people were. For the future, they have wiggle room for a reason. They want to see what the data provides. If the data suggests that the US is slowing down, if it suggests that the strength of the dollar is creating a problem for the US economy, or if the labour market doesn't continue to strengthen, then we really might not see rate rises for quite a while yet. That would have a negative impact on the dollar. For now, I still think, given what we've seen in this communique, the thesis that the US is in a different place in the monetary policy cycle from the rest of the world probably remains good, and so I doubt that the dollar reverses much more. If the data looks bad, that could change. It's going to be a very interesting few months ahead while the Fed works out what to do. I'm looking forward to it. Now, better go home.